All right, there's a new analyst note out from Goldman Sachs. It's warning that the U.S. could see unemployment rise again to around 4%. The economists led by Joseph Briggs on this one say it's likely unemployment could reach 3.8% by the end of 2023, 4% by the end of 2024. And the prediction coming as a new wave of layoffs is hitting tech, Shopify pulling offers, at least for interns right now. And there's also some rumors about layoffs on Wall Street as well. This was a really interesting note with a lot of different interesting data points. Talked about things like the divergence between the household survey and the non-farm payrolls number, and gave sort of Goldman's trajectory for what's going to happen in terms of jobs. Not just that unemployment rate, but also the number of jobs and how much growth is going to slow.
Right. And it's a question across the industries that have already started to announce some of the either layoffs or hiring freezes, how much and how long that continues to have an outsized impact. And in the role types for not just the younger parts of the population that's trying to get into the workforce, but especially on that upper end of the workforce as well, where there were so many who had been looking to retire or were forced into retirements at the onset of the pandemic. For anybody that now, because of a job loss where they were expecting to hold that on even longer, where does that also kind of create this broader whirlwind of people who are trying to get in at the higher age of the spectrum and then at the lower end coming out of college and looking for jobs as well, even if we do see this kind of compression in the employment situation?
Yeah, if you dig into this Goldman note, those folks might have a challenging time. Goldman looking for 60,000 jobs a month to be created. So every month next year, Goldman is essentially looking for an average of 60,000 jobs created next year. That would mark a slowdown from about 150,000 they're looking for in the back half of this year. Interesting, though, they're looking for 1.4% GDP growth next year. So Goldman's still not in that recession camp. But again, you're creating 60,000 jobs on average a month, 1.4% GDP growth. That sounds a little stagflationary to me.
And they're also talking about that because the labor market has been so strong, that should cushion the situation to some extent. In their words, they say there's the possibility that very high labor demand might limit labor market deterioration. So, you know, they're sort of couching all of this a little bit. And as we mentioned, there are some reports now about the latest about what's going on in the jobs front. We've been hearing recently about big tech companies that are either pulling back on hiring or outright laying people off. The latest insider reporting that Shopify is rescinding job offers specifically for interns, right? So it's not like we're talking about, you know, people who are full-time workers who are going to be higher up in the company, but that's the pipeline.
Well, next shoe to drop here is Goldman. I mean, not Goldman. It just banks
Wall
more
Street,
broadly.
yes.
I mean, a really cool or really helpful post over the weekend from the New York Post talking about potential Wall Street layoffs after these challenging quarters. The story was highlighting a lot of folks out there just essentially sitting home, not doing any work, going out there and doing charity services. That's not a sign of a healthy Wall Street community.
Well, and it's a big switch, right? All of the last year, we've been talking about worker power.
Right.
And that has extended to Wall Street as well. We all remember the memo that the younger junior bankers were complaining about working 100-hour weeks, right? Mm-hmm. So this is now a flipping of that. Those people don't have enough work to do. Investment banking revenues down some 40% at these banks. Right. That means a lot of people sitting around twiddling their thumbs, or
sounds like hanging out at the pool,
or maybe only working 40 hours a week instead of working 100 hours a week.
But in a very tropical location as well, some of them may be at. I think it also, though, it goes to show that even in this time period, too, when the deals start to come back, that there's going to be a lot of work that's required, and on what employee base, what headcount are they going to be able to complete a lot of that deal making, whether that be in the form of companies that want to go public or in the form of acquisitions that also might be kind of kick the tires.
Well, that's a very good point, because that's why I think banks have been so reluctant to start laying folks off, because it's just still a general sense that business will come back next year. You're going to need the talent, and you have to get these people trained, and you have to do it now.
That's right.